Hello, everybody. My name is David Kelly. I'm the Executive Director here at the British Chamber of Commerce in Singapore, and a very warm welcome to the first webinar of 2022. And it's a BritCham Presents, and it's on global markets and strategy outlook for 2022. I'd like to thank our event partners, NatWest Markets, and our panel of expert speakers for joining us today. They will be introducing the NatWest Markets annual flagship publication and sharing insights on the main drivers of potential market moves and how markets might react to key events over the next 12 months. This is certainly a particularly key year for a lot of businesses, as we've been gathering information from our sentiment surveys on the businesses on the ground here in Singapore. So this session is going to look at the assessments and analysis of major market topics, including FX, along with deep dives into important political and macroeconomic themes, including the evolving ESG and sustainable finance market, post-COVID economic recovery, global supply chains and labour issues, and some post-Brexit analysis as well. This is another interactive session, so if you would like to ask our expert panel of speakers a question today, please do use the dedicated Q&A box on your Zoom toolbar, and I'm sure we will try and address these throughout the session. This session is also being recorded and will be available on our on-demand section of the website and through our social channels too. So if there's anything that you want to revisit that you've heard today, you will be able to do so. So with that, I would like to hand over now to Ross Walker, who is the Chief UK Economist and Co-Head of Global Economics at NatWest Markets, to kick off the session. Ross, really brilliant to have you and the team with you today. Thanks so much for your time. Really looking forward to the session, and over to you.
Well, thank you, David. Thank you for that introduction. Good afternoon, everyone. My session is going to be looking at some of the big macroeconomic themes. I'll then pass on to my colleague, Pei-Chen Lee, based in our Singapore office, to look at the Asian economy, the Chinese economy, the outlook there, and to our colleague, also based in Singapore, Galvin Che, who will be looking at some of the market implications. And then for our final session of our 4 brief sessions, we will be passing over to Caroline Haas, our Head of Climate and ESG Capital Markets, and then we can hopefully take any of your questions. So to dive straight in, the first slide, slide number 4, looking at economic growth. We put our year ahead together early to mid-November, really just before Omicron flared up. The good news is that although we'll probably have to trim our GDP projections for the major economies in 2022. Fortunately, those forecasts are not requiring major surgery. It looks like we will see slightly slower growth in the 4th quarter of last year, 1st quarter of this year, but we will probably, in these major economies, it looks like avoid even a single quarter of negative economic growth. So a much milder economic impact from Omicron than what we saw a year ago. Bear in mind, in the 1st quarter of last year, the Eurozone, the UK, these economies were largely in lockdown for most of the 1st quarter. So the growth outlook looks relatively encouraging. The chart you can see looks at GDP in level terms. I think this is a clearer way of gauging where economies are in this recovery than if you look at conventional growth rates. And you can see the US leading the way. Very shortly, we will see not only US growth continuing to recover, but essentially back onto something like its pre-crisis trend line. The Euro area and UK are still lagging a little bit, but growth rates, we think, remain relatively buoyant this year. And just one theme to emphasize here, the growth rates you can see, just the red typeface. These are quite buoyant numbers, typically 2 or even 3 times for Europe and the US, the sort of growth rate you would expect. And that's because we are still in this post-pandemic catch-up phase. There is still a level correction occurring in GDP. So although there is a serious headwind from inflation, we'll look at that in just a moment, nevertheless, in real terms, this should still be a relatively strong recovery year for the major economies. So jumping to the next slide, the other big theme we think for 2022 will be higher, stickier inflation. We've seen in the early part of this year, the latest inflation data in the US and the UK yesterday, again coming in above expectations. The good news on inflation is that we are now at or very close to the peak. Now, it's the big question, therefore, I think for policymakers really is how fast inflation falls back. You can see the left-hand chart. Our expectation is that a lot of this inflation will fall back quite quickly, simply a base effect. Inflation is a year-over-year change in a basket of goods and services prices. And so those one-off energy shocks, we think will wash out. The bigger risk, however, is that the pervasive nature of an energy price shock means that costs more generally will have risen, and we may see therefore some change in pricing behavior over time, and therefore maybe a bit of stickiness to that inflation. So that the issue is not really, is inflation going to fall this year? It is, but it's really how quickly it falls and how far it can progress back to target without more drastic monetary policy tightening being required. So the energy shock, the cost shock, we're probably more confident about that unwinding. The bigger uncertainty is really reflected in the right-hand chart on this page, looking at a gauge of essentially supply chain strains. So this is the PMI survey's delivery times index. Perhaps counterintuitively on this measure, that the lower the reading, the more strained delivery times are, and you can see that we are still at historically stretched levels. It may be that little upturn in that indicator over the last month or two is a sign that some of these supply chain pressures are beginning to ease, but clearly there are big variations across economies and sectors, and this is something that Pei Chen did a lot of work on in our year ahead, and she has some more detailed slides on this later in the presentation. So to sort of bring this all together, the next slide, please, slide number 6. As I say, the inflation shock has been primarily a global supply one rather than a domestic demand one in nature. And the good news about that is that historically those supply shocks have been easier to deal with. They tend not to be as persistent as when you have overheating demand. It does feel a bit more difficult this time, partly because of the extent, the persistence of the energy price shock currently underway. But nevertheless, that we should be able to deal with this, we think, with some comparatively modest monetary policy rises. As I was saying, inflation will inevitably fall this year, but it's really about how quickly inflation falls. We're less concerned about some of the commodity price aspects of this. Supply chain problems could be more persistent. And the big question really is the extent to which these, what was in origin a cost shock, changes and morphs into domestically generated inflation, principally through the wage inflation channel and higher wage inflation. And for many economies in Europe, the UK, the US, this is the key time of year. The beginning of the calendar year, the start of the financial year in a few months' time. This is when you tend to get those big pay settlements taking effect, and that will be a key driver of consumer demand and domestic inflationary pressures over the next year or two. So the next few months, I think, in terms of those wage setting developments, will be critical in shaping the inflation outlook. We still do have fiscal stimulus. There is quite a bit of variation between economies. Most immediately in the US, you have a powerful fiscal stimulus being overlaid on an economy that was really already gaining significant momentum. And so we think the inflation pressures will be most pronounced in the US. But we also have longer term fiscal stimulus measures, particularly in the EU with the Next Generation EU Recovery Fund, so a structural fiscal spending to underpin investment and infrastructure. And this has a multi-year dimension. So whereas maybe in the aftermath of the global financial crisis, the fiscal policy orthodoxy was more towards conservatism, reining in deficits. It feels quite different this time. There's more emphasis on active fiscal policy, and certainly that is something we expect to support demand both in the near term and over the coming years. And so what does that mean for central banks? Well, 2022 is going to be a year, I think, characterized by interest rate rises. A number of central banks are already raising rates. Reserve Bank of New Zealand, Norges Bank, the Bank of England. Crucially, the US Fed, we think, will be joining that group very soon. We look for quarter point interest rate rises from the US Fed as soon as March, followed up in June and December. Risks of a fourth hike this year. We'll also have some quantitative tightening in the US. So really a more rapid and more aggressive monetary policy response in America than what was expected maybe just 6 months or so ago. Bank of England is already tightening interest rates. We expect another rise at the beginning of next month in February, with a further at least one more rise later this year, and probably, given the inflation pressures in the UK, probably ongoing interest rate rises in 2023. So this is not a one or two and done theme. I think this monetary policy tightening theme is going to run for several years. The ECB is probably towards the back end of that wagon train, but even there you're seeing tapering coming this year, scaling back of QE purchases. And although we don't see any interest rate rises from the European Central Bank this year, maybe not even in 2023, you're clearly going to get market pressure and markets beginning to price in these rate rises. And you'll have seen in other European markets, symbolically, German 10-year bond yields, which had been trading in negative territory, moving back to zero into positive terrain. So, a significant shift is underway. It remains to be seen just how far interest rates need to rise, but definitely the theme in markets is there is a reassessment going on, and sort of expectations, I would say, of where rates need to reach are being reset higher. So on that note, let me pass over to my colleague BritCham to look at the economic outlook in the Asian region. BritCham.
Thank you, Ross. Can we have the next slide, please? At the beginning of my presentation, I'm just going to continue from the topic that Ross has touched on. We are currently in a world of shortages, from ships to chips, from energy to food. Everywhere we are seeing a shortage. So we have actually conducted a more in-depth analysis over all the shortages in our year ahead. And the conclusion is that we really don't have a one-size-fits-all forecast for when the shortages will ease. In fact, some of those are COVID-related. Lockdowns caused raw materials to be hard to transport out of those resource exporters. For those, we think reopen will probably alleviate some of the shortages. Whereas for shipping, bottlenecks was caused by lockdown as well, partially. And we do expect shipping costs to be coming down, normalizing with more countries reopen and shipping routes getting reconnected. But I think that it's trickier for shipping, particularly. We think normalization is likely, but it will unlikely to return to pre-pandemic levels quickly and efficiently. So on that note, we think that shipping bottlenecks might be persisting in the medium term, but the strain has been, the worst might have been behind us. Also on a labor shortage, where Ross has been mentioning, the focus right now will be on if wage increases, which cause a further rise in demand, and that will put more strain on shortages. And more importantly, sitting in North Asia, we think that semiconductor shortage is something that we really focus on. The good news is that the North Asian semiconductor firms, they have started their capex investments since mid last year, recognizing the shortage in demand, in supply. But the bad news is that it's very highly cyclical in nature. Typically, it takes around 6 to 8 quarters for semiconductor firms to ramp up its production capacity. So we think that the situation might be improving until late 2022 or even early 2023. So moving on to the next slide, I'm going to touch more in detail about China and its common prosperity theme. So we all know that China has started achieving common prosperity as one of its top goals for the long term. At the same time, China also rolled out a couple of regulatory changes to many sectors after the common prosperity slogan, which caused quite a bit of confusion to markets. We think that common prosperity will likely to become the main theme for policymaking in the next decades. But that doesn't really mean the focus will squarely be on redistribution of wealth, but rather we think the focus for growth will gradually shift from quantity-based growth targets, for example, achieving GDP targets at all costs, shifting towards achieving a higher quality growth, which emphasize more on rebalancing and redistribution. So moving on to a relatively more short-term growth outlook for China, China is actually on a different economic cycle compared to the rest of the world, especially the developed economies. We forecast China facing a lot of downside pressures for 2022. The growth pressures, headwinds coming from three major areas. The first one is a demand contraction. The Q4 GDP and annual GDP data released this week was particularly spelling out the trend. Consumption is a clear laggard of recovery, partly because China continues to adopt a very strict zero COVID strategy, and also because China's policy stimulus since the pandemic have been focused much more on the supply side, and there's a notable missing piece on demand side easing. So demand remains relatively weak domestically. The second headwind that China will face will be supply shocks. As the same as the rest of the world, China also faces shortage of raw materials, facing high shipping costs, as well as labor shortages. So this will push up producer price inflation and erodes into corporate profitabilities in Chinese corporates. And the third headwind, and most importantly, China faces weakening expectations. And that stemmed from rising regulatory risks since last year, as well as a more prolonged than expected property sector slowdown. We have not yet observed the contagion effect from the property developers' default last year, but obviously that has been putting some downside pressures on the sector's growth as a whole, as property sector has becoming from the driver of growth after the pandemic to the lagger of growth in Q4 2021. So we think that weakness is going to continue, and China's growth will largely depend on its policy mix coming up. And we think that China faces a policy trilemma currently, which namely its zero COVID strategy is putting a lid on growth potential. The restraint easing, deleveraging on the property sector, regulation on various education tech sectors is also putting a lid on China's growth. But at the same time, China tried to stabilize growth in a politically important year for Chinese policymakers. So we think in view of the policy trilemma, China will continue to strike a balance among all three of these. In the very near term, we don't think zero COVID strategy is going to be relaxed, but China does need to have a stable growth rates ahead of its party congress in October and November. So we think moderately stronger easing is most likely to be relaxed as the side of the equation. So we're seeing a hint of that. The PBOC has tilted much more dovish decisively in January, with triple R cuts and rate cuts consecutively. We think more will be coming, especially in the first half of this year, as the PBOC becomes moderately more dovish. Downside growth pressures will partly be offset by the monetary easing. The silver lining of China's growth is, of course, its external sectors. The post-pandemic supply shocks, even though it hurts China as much, but China has also benefited because its export share rises in view of the global pandemic hit, as China fills the role of global supply chain gaps. But as more countries reopen and return to operations, we think there are downside risks to China's exports. And we think it's very likely that China's export growth will normalize, especially into the second half of 2022, when the high base effect kicks in. To broaden out the picture a little bit, I'll be covering on the Asia's outlook. Next slide, please. So similar to the story of China, the Asian countries has also benefited from a global increase in goods demand during the pandemic, especially from the developed countries driven by their fiscal stimulus. So if you look at the chart on the left-hand side of this slide, Asian countries' goods exports have been generally growing very well and well above its pre-pandemic levels. But we think a rotation of growth driver is likely in 2022 due to the very same reasons. Developed economies might be reopening further, shifting their goods demands towards services demand. So we think goods exports will likely to be normalizing into the second half of 2022. But at the same time, regional economies, which typically depend on tourism and services inflows, might be benefiting from this rotation. The countries we're looking at includes Thailand, Philippines, Malaysia, or to some extent Singapore as well, might be benefiting from this rotation. And especially, we think that these regional economies will the rotation will be more evident after China eases its zero COVID policy and more Chinese tourism comes into the region. So that's all the brief overview of Asia and China's outlook. With that, I'll just pass it on to Galvin, who will dive deeper into the central banks in the region. Galvin, please.
Thanks, BritCham. So if we can move to the next slide, please. As Ross and BritCham have noted, I guess over the course of this coming year, it's a general expectation that interest rates and bond yields will both rise. But I think it's worth noting here that these will be rising at different paces. Broadly, we can think of those that have led in terms of central banks raising interest rates, particularly in the emerging markets, which we can see in the right-hand side chart. And these have been concentrated primarily in Latin America and in emerging Europe. Contrary to that, there's also been what we call a squeezed middle of central banks in the developed G10 markets waiting to act, such as in Canada, Australia, and as mentioned, the US. And those, of course, that are more content to go at a slower pace in removing accommodated policy and in raising interest rates, such as Indonesia. And of course, BritCham's noted, to the contrary to all of those, to these trends, China has been the one that's actually been reducing rates and sort of increasing accommodation to the economy as the economy there faces additional headwinds. So I think in terms of these dynamics as a whole, in Asia, the effect has been rather different to the rest of the experience in the developed world or to the other sort of Latin America, European and African regions, right? Where our analysis has shown that in many of these, in ASEAN countries in particular, the impact of COVID has not only been larger, but the government stimulus responses have also been smaller. Inflationary pressures have been less acute, and in fact have been looking slightly more transitory as well. And as mentioned, China has also moved to conduct more monetary stimulus in the face of growing economic risks to their economic growth path. It's evident across the board then that there's a divergence in both the pace and the direction of interest rate increases, as the chart on the bottom on the right-hand side as the chart on the right-hand side shows as well. So what this means is that we've seen markets that have been fixated on bonds selling off, particularly in the US. And our analysis so far has suggested that we'll see shorter dated front-end bonds sell off faster than the longer end, right? So basically a flattening of the yield curve. And whilst this dynamic, particularly in the front end, the shorter dated ends of the yield curve, has been fairly rapid, it's been happening in such a way as to not spook, broader market sentiment, broader risk sentiment. And I think this is very much in contrast to what we saw at the beginning of 2021, where markets were pricing in sort of much higher interest rates and much higher yields at a pace significantly faster and sort of in a more disorderly way as they have been in recent weeks. If we could move to the next slide, please. I think what's kind of interesting as well is the currency response. I think that's going to be very much a function of policy rates. So central to our view for this coming year is this idea that the US dollar will continue to appreciate. And we think that this, along with rising interest rates, is a good lens with which to view the financial market response and setting the scene for markets this year. And so I guess the question, is why should the dollar strengthen? I think there's been a couple of points fundamentally which underline this view. So on the one hand, the US recovery has remained fairly robust. Inflation there remains high, and the US Federal Reserve, arguably the world's most important central bank, has been talking up the prospect of more interest rate rises and at a faster pace this year, as Ross has already alluded to. We think this favors currency flows in favor of rising short-term interest rates as a whole. I think conversely, there's still a muted response. The expectations of a still muted response from the European Central Bank, and their determination to only move gradually towards monetary stimulus could see the world's other major global currency, the euro, lagged behind some of its developed market peers. I think as well, one of the major theses that we're approaching this year with is that this idea that the natural resource and natural resource exporters will stay particularly relevant as a theme for financial flows, and particularly in fossil fuels. I think this is obviously somewhat ironic given a lot of the ESG-related thematic focus that we've been seeing rising throughout the pandemic. But bear with me on this. I think this idea that we'll have gradually rising demand as well as squeezed oil supply should continue to be a boon for natural resource exporters, particularly in the oil sector, of course, and that these are particularly correlated and bode well for countries that are typically seen as highly correlated expressions of natural resources, in places like Australia, Canada, Norway, and Russia, and their currencies as well. On this slide, I think this highlights this idea that regional differentiation outside the developed markets will be fairly key. Sorry, if you could please go back to the previous slide. So this context about how developed markets and the developing markets will proceed is fairly important in thinking about how the relative pace and the distribution of assets of asset allocation will proceed in the course of this year. In the emerging market space, we think that'll be likely a tougher year for currencies, particularly as tailwinds from net exports fade, as growth on the whole slows versus the developed G10 economies, and as the dampener on risk from rising bond yields and rising central bank interest rates works through these economies and these markets as well. And of course, I think we have to, of course, factor in the occasional COVID-related scare that may be sort of a risk to the path for these economies. So the chart on this slide, I think, is a fairly important one in our view about the distribution of growth and how assets might be allocated this year. So this chart shows the difference in the forecasted growth paths between advanced economies and emerging and developed markets by the IMF. And we can see that this year in 2022, sort of the differential, the premium that emerging and developed markets hold in terms of growth over the advanced economies will actually be the narrowest that it's been in quite some time. I think going back in this chart, as this chart shows, to the early 2000s. So I think that, so whilst many less economically developed nations will unfortunately have to struggle with the continuing social, health, and economic angles of the recovery, that also suggests less of incentive for foreign capital to flow to these economies, given the less of a growth premium and less markets and assets there growing at a relatively slower pace that they have before. If we could move to the next slide, please. So on the next slide, these two charts I think show some of the dynamics that I've mentioned quite clearly. On the right-hand side, this shows the dynamic that I've mentioned about this sort of relative growth differential and the relative allocation of assets towards emerging markets being slightly weaker in fairly stark contrast. So what we can see here is how the portfolio inflows into emerging market bonds and emerging market equities has actually slowed. The orange line shows how flows to emerging markets has been slowing after a particularly large pickup towards the sort of more optimistic times in late 2020 and 2021. In contrast, while flows to China have also slowed, they still remain noticeably above that of the rest of the emerging markets in general. And in fact, it's worth noting that the flows to emerging markets actually have been below the 5-year average for the last quarter of the last year. So I think in this context, this paints a fairly stark divergence between China, which remains the exception, and the rest of the emerging markets as a whole. One theme which we do think will continue to remain relevant this year is the prevalence of trade flows and their relevance for markets, particularly among the more industrialized, more sophisticated, and more export-heavy Asian economies, namely China, South Korea, Taiwan, and Singapore. The chart on the left-hand side shows how, in particular, pandemic-related demand for Chinese exports have driven appreciation of the renminbi, And as capital outflows from China will continue to remain constrained this year by a combination of, as BritCham mentioned, lesser tourism outflows, as well as highly regulated capital outflows. We think that overall this suggests continued appreciation in trade-weighted terms for the Chinese currency, particularly as we think markets will trade on a little bit less of an optimistic footing, and how currencies might fare weaker on the whole versus the US dollar. That's it from my side. Over to Caroline.
Good afternoon. Thank you very much for your time. I think, ESG is one of these hot topics that seems to gain a tremendous amount of attention, and to be honest, continues to accelerate. When you look at my first slide, and I will just start right away into the actual instruments themselves and the growth of that market, and then we'll actually move on to some of the key takeaways from COP26 and how we think that is actually going to feed into further development in 2022 and beyond. I think one of those charts to look at is sort of on the top right, where you see the market development, and just to see the absolute acceleration of new issuance that we saw in 2022. I would say there's a slight tapering of the green, but in many ways that's on the back of COVID, and where social elements were called out, which also needed to be financed. And often there is now this sort of partnership between green and social, and to really bring that narrative of a just transition or building back better together, that you actually need one for the other. On the top of that chart, there's a sort of evolving dark purple. And I think that is really interesting. Those are the sustainable linked bonds, where you actually have specific KPIs that are set by either the company or the FI, but also, as we have recently seen in the sovereign space, to actually very clearly define what their climate-related targets are, when they expect to achieve them, and then if they have not achieved them, to actually have financial consequences, meaning that there would be a step up in that coupon. Now, I think that is particularly interesting for the corporates, who probably don't issue as often as some of the SSAs or financial institutions, but it also ties very clearly to their corporate strategy. The other area that we really feel that this is going to evolve is actually for emerging markets, particularly in the sovereign space. And recently, Uruguay actually issued a sustainable linked bond where they tied their NDCs to this. So really clearly defining what their expectations are and how they are going to actually aim to attain the emission reductions going out to 2050. Now, that I think you're going to hear and see a lot more of. As you'll see, we now have, about 2.5 trillion outstanding. We crossed the line of 1 trillion in May 2020. And what you'll see at the bottom left chart is that we're actually expecting about another sort of 1.2, 1.4 trillion of new issuance in 2022. I think the mix starts to look fairly similar, although I think we're starting to tend to feel that the corporates are really going to accelerate versus some of the other areas. The other interesting thing is that the euro continues to dominate with about 50% of the issuance, but we really feel that the US dollar market is going to grow rapidly in 2022. One, because there's more and more issuers looking at it, and secondly, there is just that need as well to have dollar capital to actually mobilize. And finally, on this slide, the thing to point out is in the euro market, we were trending at around 10% of labeled issuance, whereas that issuance now has jumped to sort of in the region of 20 to 30%. And that is definitely going to continue to grow as organizations change their business models, tend to be much more focused on purpose-driven strategies, but also ultimately to finance the green infrastructure that we need to actually hit those underlying climate targets that have been set. So as you'll know, there was obviously a rather big event in Glasgow in November, And, I had the great pleasure of being in the NatWest delegation, and it was my first COP. It was fascinating. It was one of those, it was like a trade fair with policyholders, with finance, industry, students, indigenous communities, which was absolutely extraordinary. And I would say the positivity very much came through. I was sort of commenting on it earlier that, in many ways we focus so much on a few key headlines, but actually when you look at what was achieved in those 2 weeks, it is quite extraordinary. One of those is to actually have methane now very much called out in this debate. It is hugely important, particularly in agricultural communities and in the agricultural business itself. So when I sort of looked at those, what were my key takeaways? One was the fact that we had finance at the table. And that, to be honest, in that frequency, in those numbers, had not happened before. We'd had, various finance ministers present, we'd had some asset managers, but definitely not in the quantum that we experienced in Glasgow. There were obviously specific targets set, there were collaborations and partnerships, and really now sort of sharpening pencils to make sure the capital actually starts moving. The second was the timelines. The timelines were shortened considerably. And, we always talked about 2050 or 2060. Well, no, now we're talking 25, 2030, and really sort of holding those people who are at the table right now accountable. The other is expanding the reach. The other is actually the emerging markets. And this is a huge area that needs support. Ultimately, it's the emerging markets that are feeling the brunt or carrying the brunt of climate change, often actually not as having a significantly high emissions contribution. And so we really do need to mobilize capital in those areas, either from a mitigation or an adaptation point of view. The third point was obviously looking at the expanded reach of COP. I mentioned agriculture, gender was brought into the discussion. It was really starting to look more at circular economy, health, food supplies. This comes back to my earlier point. There is a distinct interconnectivity between climate change and these other areas, which actually need to be considered and brought to the forefront. Collaboration, absolutely. Nobody can do this on their own. This has to be a global effort. And it's actually solving how we all come across and sit around tables and actually now start doing the heavy lifting. And as the FT actually pointed out, was the normality. And suddenly it's now in every boardroom. It's being discussed in every government level. What are we doing? And finally, the role of the carbon markets. And NatWest is actually very active in this. We've partnered in something called Project Carbon to facilitate sort of the labeling or determining what is a good carbon credit. And so we were very pleased with the outcome, that in many ways, Article 6 has now been resolved, which was always an outlier since Paris, and really knowing how should we work with carbon offsets. By no means should they be the answer, because that's not feasible. But nevertheless, they do have a role to play. Now, the ESG has such an enormous impact on so many things that we do. I'm sure many people get bored of that term, but nevertheless, we really need to see that it's a measuring tool. Ultimately, it's how we start to shift and look at our companies, our governments from a slightly different perspective. And that's why, we talk about this democratization of the data, because it's really important that we all have access to this data. And this is actually where governments will play a huge role to actually release some of the sovereign data that they have that we can now use for our modeling that will be needed. Similarly, and that feeds back into this decarbonization position, we're all trying to measure emissions, either from a loan book, from a portfolio basis. Their companies are trying to do this. And so it's a constant sort of feed of how we can use this data. The other is that you've got more and more issuers, and it was sort of my point earlier about increasing the frequency of issuance and the use of these tools and the actual shift of companies and business models to incorporate ESG. So you're going to see that. One thing we do like to call out is that the sterling market has been slightly hesitant to take on this new maybe aura that we're all calling ESG or green. And, it's great to have seen the government, the UK government, the UK government to issue a green gilt. We were involved in their 2053s, which was on the long end, and have this bond, 10 to 12 times oversubscribed. Now, the benefit of a sovereign doing this type of issuance is the fact that you then have other issuers feeling more comfortable to enter the market, which we've seen in France, we've seen in Italy, we've seen in Sweden. It just gives that credence. And so now we're really quite keen that the sterling market has already gone from about 3% to 5%. And we're seeing many new issuers and also non-UK issuers considering the sterling market, which they wouldn't have previously. And finally, there's an enormous development. So I think this is really the takeaway here is it's a greenification. And I don't just mean green, I also mean social, but a greenification of all instruments that we operate with from a funding or financing or hedging perspective. We've done our first repo now. Obviously, the sustainable linked loan is very active. We've done ESG linked deposits. We are now looking at liability management, where you're calling the bonds and then actually using the new proceeds that you've attained for the bond, which then becomes either a green or social bond. So lots and lots of development. So as you can see, this sort of outlines where we see the growth, and you definitely see the corporates surging. You have some growth in the FIs, but the FIs, to be honest, are constrained slightly by their assets, and also generally they're actually quite well funded. The sovereigns is a big focus, and you will see continued issuance in that space. The UK obviously is going to follow a similar structure of Germany with creating a yield curve. And France has already announced that they're very much looking at an inflation-linked green bond to sort of build out their repertoire as well. The supranationals, I think what you're going to see there is ultimately all of their funding is going to shift, and they will just be rebadged. Agencies play a big role, meaning that it will start to bring into the local authorities some of this activity that we really require. We don't really expect any change in the sort of breakout. As you can see, 50% will still be green. I guess the main shift will be some of the sustainable and social will shift into sustainable linked bonds. And then I think the final bit is just sort of very much looking at, the greenification and its impact on inflation. It may still be early, but the expectation is as we roll into 2023 and we start to drive a lot of the refits, the refurbishments, actually also the buying, and we were talking earlier about supply chains and the production of a lot of the heat pumps and some of these requirements that we need. It is going to drive the costing of this. And the other one to call out very much is the carbon tax. We are starting to look very closely at how do we actually quantify carbon and how does that impact the supply chains, where they come from, the pricing. And if the EU, as they're obviously discussing, is to apply a carbon tax, then the pricing would suddenly shift when it comes from Asia to Europe versus what is then produced in Europe, adding the additional carbon cost from the shipping, as well as potentially the production of those products that have not been done in a green manner. So I'll stop there and pass it back to Ross.
Well, thank you, Caroline. Thank you, Pei-Chen and Galvin as well. We now go to the Q&A session. So please do submit your questions just in the usual way, just by the Q&A function, the text function. I kick off with the first one. It's one for Pei-Chen, I think. It's about Chinese GDP, Pei-Chen, and whether, or the extent to which the slowdown we expect to see in this year's numbers, to what degree we should view that as stemming from COVID-related factors. You've mentioned some of the quite strict lockdowns that are still going on, and how much of it do you see as a longer-term structural development, the common prosperity attempt to change the Chinese economic model and Chinese growth?
Thank you, Ross, for the question. So the shift to China's growth is actually happening before the pandemic. In fact, I would categorize the change starting from 2017, when the authorities started deleveraging policies, where they limit the debt growth and restrain from using debt-driven policies such as property developments and infrastructure investments. But in fact, for this year, I do see the pictures turning differently. I don't think these deleveraging policies will continue to be a drag for growth in 2022, as they were for the past few years, because there has been a shift in policy tones over moderate easing to offset downside growth. So in the short term, in 2022 specifically, some infrastructure investments are actually going to pick up to become one of the factors to offset downside growth. But talking about medium-term shifts such as rebalancing from investment to consumption, I see that as a long-term trend. So that's probably weighing on average 1 percentage points to China's GDP growth. So China's potential growth will probably be settling at a lower range of 5 to 5.5%, compared to what we observed at above 6% before the pandemic. And on the question of how much is weighed by COVID-related policies, I think that will be, that back of the envelope calculation will give you somewhere between 0.3 to 0.5 percentage points to GDP growth if China continues to uphold its zero COVID strategy for the entire year. So our forecasts have actually factored that into the consideration. That's why we penciled in our annual forecast at around 5.0% for this year.
Thank you, Pei Chen. We have a question for Caroline, which has come in. Caroline, thank you for the presentation. Are you able to comment on the current and potential trends in pricing differentials for green bonds versus conventional bonds? What factors might affect the pricing differential?
So this is a really good question. Now, I think what has actually really transpired, there is a greenium. Now that greenium will change. It will change across the rating. It will change on the currency. It will change on the issuer. It will change on the actual instrument itself. So for example, we'll see differences in the FI space between where the quantum is for a covered versus a senior unsecured or senior secured or a capital. But ultimately, the primary driver for the greenium is the oversubscription rates. And I'd referred to the UK being 10 to 12 times oversubscribed. And just to give you an idea, those were the largest order books that the UK had ever seen. It is underpinned by this ongoing demand. We haven't included this in the pack, but the growth of ESG targeted investments is just astronomical. And so, you know, and one of the reasons is just that it's a combination, I'd say. It's an asset owner driven discussion, which is also then taken back to more almost like a generational shift. You have the millennials definitely asking that question, but you're also having that their impact on their own parents also being played out. So you do see it also in the baby boomers coming through. The second is policy. So, you know, in the UK, now the pension funds have very clear stewardship codes that actually asks them to include E, S, and G into their analysis. So there's a requirement, plus there's a desire that is actually increasing the order books.
Lovely, thank you very much. We still have about 5 minutes, so if there are any further questions, please do submit them. I have one here, I think, for Galvin, which is, you know, you've highlighted this differentiation between rising interest rates in much of the most advanced economies, but we see interest rate cuts, potential further easing in China. Which is going to be the more powerful influence on most of the Asian regional economies, and are there any big currency implications there that you see?
Yeah, definitely. Thanks, Ross. I think that's a very interesting question, and that's something that Pei-Chien and I have been actively sort of working through and actively trying to have discussions around as well. I think I'm reminded very much of this quip from one of the IMF papers that says that financial flows and monetary policy globally is basically set from Washington, whereas the current accounts, basically, some of the trade accounts, is set from Beijing. So I think there on that aspect points out the sort of very divergent effects of how these things will be going. So on the one hand, I think a lot of the markets in the Asian region, particularly the central banks and how they're responding, are still very much caught within the gravitational pull of what the Fed and what the developed markets are doing. So just earlier today, even Indonesia's central bank, Bank Indonesia, made explicit reference to the sort of the policy directions of the Fed in attempt to lay out how they might respond to what is still fairly tepid inflation, but gradually rising inflation and a gradually progressing recovery, and very much so, the focus was very much centered around the Fed. I think it's also worth noting that I mentioned just now this idea of financial flows into portfolio into equities and bonds coming from overseas investors. A lot of those decisions are based primarily around the reactions to interest rates in the U.S. and the returns that one gets from U.S. instruments rather than the local currency ones. This idea that Pei-Chien mentioned about rather on the other hand, the People's Bank of China easing interest rates to support what is a slowing economy. I think our expectations there are for much more measured responses to stimulus. So the expectation isn't for what we saw earlier in the decade, where we had these tidal waves of credit stimulating construction of roads and highly intensive building projects and underground railways and buildings. So the expectation is that we're not going to see much of that. So I think how that translates to the regional dynamic in the form of demanding natural resources and different components along those supply chains is probably going to be a lot more measured than what we have seen in prior years.
Thanks, Galvin.
Whoever. Yep. No.
Sorry, I didn't mean to cut in there, but carry on.
No. That was basically it. I think in the end, I think we can expect that the U.S. Federal Reserve will be the one that sets the scene more for regional economies than the PBOC.
Great, thank you. One more ESG question here, and Caroline is asking about. This has also been a major theme in Asia, of course, and whether there's anything you can say about the likely trajectory of Asia's impact on these markets.
No, thank you. I think Asia plays a huge role. There is going to be a lot of activity. One, there's a fair amount of obviously investment opportunities, and in addition, that's where a lot of the infrastructure needs to come in. So you've got both. In many ways, you see what the Chinese government is trying to do. The EU taxonomy and the Chinese taxonomy, they speak a lot. So, as much as we can kind of feel that you want to kind of say the Chinese aren't moving, they actually are. And so they are trying to kind of get that sort of intent, that rhythm. We've spent a lot of time with SAFE and just seeing how they're starting to instill ESG. And to be honest, we did a survey probably in September, where I have to say I was absolutely bowled over to see also in Japan how many of these asset managers or insurance companies are very much instilling ESG strategies, responsible investing policies in place. And the other real key takeaway from that was how much they're focused on decarbonization. And when they do take those investment decisions, is there a decarbonization strategy to that asset? Now, these are all the right tones that you want to be hearing. And so I think the combination of the need for the infrastructure, as well as that developing sort of center of liquidity to fund those projects is really, really important, and is vital and is present. So I think just, you'll see that developing strongly. Ross?
Thank you very much. I think we are almost out of time. The one other little question came up. This is probably just for me. Are we going to get an early UK election? Is Boris Johnson's political life about to end? I don't know. Probably not. I think he probably just about rides this out. But we get this official report into what he knew about this garden party. So that's due next week. So that could be a crunch point. The local elections in the UK in early May might also bring some volatility for sterling. But I think rising political risk in the UK is probably more of a 2023 story. So maybe on that semi-optimistic note, I can pass back to David Kelly, and just to say thank you very much for joining today and for your questions and participation.
Oh, thanks so much indeed, Ross. That was a really great session. Thank you to yourself, Ross, to Galvin, to Caroline, and to BritCham as well for a fantastic session. Of course, to our event partners today, NatWest Markets. Presented some really excellent insights covering some incredibly pertinent topics affecting businesses over the coming year, particularly around that Omicron and not derailing recovery, which was quite positive to hear, the forecast of normalization of supply chains, China's policy strategy together with tourism and regional growth drivers, and that ESG and COP26 outlook and expectations. A really, really brilliant session. So thank you again to all of you for today's sharing. And there's some good questions in there as well, and some great meaningful dialogue. And that's exactly what we're all about at the Chamber. So please, of course, do join us in the future. I would just like to highlight a couple of things that are coming up, some fantastic webinars, which you can hopefully see on your screen now. We've got a really great session on creating culture of learning within organizations. We're seeing a big shift around that at the moment, certainly here in Singapore. And we've also got a great event. It's our new Bridging the Gap series, or our B2G series, which is helping to connect closer to Singapore government. We've got a great session on planning for sustainable growth and the future of tourism in Singapore, and certainly some of those themes are linked around tourism we were discussing today. So please do check out those. You will, of course, receive a feedback form. Please do fill that in. It really helps me and the Chamber team to understand what you'd like to hear more of and how we can help shape amazing content again for you and your business. So that leaves me to say a final thank you for joining us on our first webinar of 2022. It really has been a great session, and myself and the Chamber team look forward to welcoming you at another event soon, and hopefully in the not too distant future in person. Take care and have a great rest of the evening.